In this video, we're going to take a look at a high-yielding dividend stock at the request of a few people over on our Patreon. It's a stock that's had a really impressive track record since their IPO in 2009. It currently yields over 9.5% and they've never had a dividend cut, which for a company that's been around this long and has consistently offered a yield this high is really worth taking a look at. But as I'll explain later in the video, even though their track record has been great, more recently they've been going through a much more challenging environment than they have in recent years. The company we're going to examine is Starwood Property Trust, ticker symbol STWD. They're an affiliate of the global private investment firm Starwood Capital Group, which is one of the largest investment firms in the world with approximately $120 billion worth of assets under management. According to their website, amid the depths of the Great Recession, Starwood Capital recognized that traditional commercial lenders were withdrawing from the marketplace and a significant need had emerged for alternative commercial mortgage financing. In response, the firm established Starwood Property Trust and took the company public back in 2009. Today, they're currently the second largest mortgage REIT with a market cap of over $6 billion. The company also has a little more unique of an investment portfolio. Although they are technically classified as a mortgage REIT, they also hold a sizable portfolio of physical properties. Some equity REITs will hold a tiny amount of mortgage-related investments, but they almost never make up a sizable amount of their overall portfolio. In fact, with most of these companies, it's not even worth going over their MBS holdings because they rarely account for more than a couple percentage points of their overall revenue. Starwood Property Trust, on the other hand, is different because about 12% of their assets are in physical properties. This would technically classify them as a hybrid REIT, which is a combination of an equity REIT and a mortgage REIT. It's a pretty rare type of company in this day and age, as most REITs now choose to either focus on physical properties or mortgage-related investments. Nowadays, any REIT that holds both physical properties and mortgages is automatically classified as an mREIT. So classifying some REITs as hybrid REITs is a term that's not even really used anymore. Two Harbors Investment Corporation is an example of an mREIT that used to be a hybrid REIT. Over a decade ago, the company held a sizable portfolio of single-family residential houses on top of agency and non-agency MBSs. It looks like they unloaded them back in 2012 according to their website, which, judging by their stock's share price ever since that happened, I personally think they shouldn't have done this. But getting back to Starwood Property Trust, let's take a look at this company and see what else makes them unique. According to what's on their website, their stock has provided an average annual return of 10% since their inception. If we look at the share price performance of their stock, we can see it's currently up over 27% since their IPO in 2009. It's still down quite a bit ever since interest rates really took off. From mid-2021, it's still down almost 30% until we see rates get cut, but you can see that this mREIT has had a lot of growth over the years, which is really unusual. If we compare STWD with the other large mortgage REITs that exist, they're the only ones that have never gone through a dividend cut. A couple of these have gone through multiple cuts over the past few years. So that really is an excellent sign of strength for this company. If we run it through a total return calculator, which calculates the total return of a dividend-paying investment with the distributions being reinvested, we can see it's done very well for a high-yielding investment. According to this, it's actually done a little better than 10%. It's delivered investors an average annual return of almost 10.5%. That comes out to a total return of 317.62% over the course of 14 years. Again, this kind of growth for a mortgage REIT is pretty impressive compared to their peers. As I mentioned in the past several times, most of these mREITs focus on one or two things. Either they originate their own loans and mortgages, or they invest in already established mortgage-backed securities issued by financial institutions. Some examples of mREITs that invest in already established MBS securities include Annaly Capital, ticker symbol NLY, AGNC Investment Corporation, ticker AGNC, and Armor Residential, ticker ARR. Examples of mREITs that issue their own mortgages and loans include Arbor Realty Trust, ABR, Blackstone Mortgage Trust, ticker BXMT, and Sachem Capital, SACH. mREITs that issue their own mortgages as opposed to investing in pools of mortgages issued by banks almost always perform better over time. Starwood Property Trust does both, but the overwhelming majority of their focus is on issuing their own debt. Their CMBS securities only make up $625 million of their more than $27 billion portfolio. If we look at their most recent asset breakdown, we can see where else this company is invested. Their own commercial loans make up 58% of their portfolio, which is spread out among different sectors. The largest is in the multifamily sector at approximately 20%, followed by US offices at 11%. Given the commercial real estate market, there's been some fear regarding the safety of mREITs that hold these mortgages in office buildings due to the large amount of office vacancies. So that's been an ongoing concern investors have, but it's been a bigger issue for some other mREITs like Ares Commercial Real Estate and Blackstone Mortgage Trust. It hasn't appeared to affect Starwood Property Trust as of the making of this video. In terms of their physical properties, they highlight two sectors in particular. This company seems to be heavily invested in the multifamily sector and medical offices. It says they're focused on investing in high-quality real estate with stable current cash-on-cash returns, potential for capital appreciation, longer duration of cash flow, and that are a natural inflation hedge. Considering Starwood Capital is one of the largest asset managers of real estate in the world, they definitely have a good connection to this company. Their properties have an occupancy rating of 97%, which is pretty good. It's not nearly as good as some other REITs like Agree Realty and Triple N, but it's above average for an equity REIT. If you remember at the beginning of the video, I mentioned that this company is going through a more challenging environment. And the reason I said that is because in the last 3 quarters, their payout ratio has been extremely close to 100%. For the past 3 quarters, Starwood's paid a dividend of 48 cents per share, and according to their most recent financial statements, in Q3 of this year, the company generated 49 cents per share worth of distributable earnings. In Q2 and Q1, they had the exact same result of 49 cents per share in available distributable earnings. That represents a payout ratio of about 98% for the past 3 quarters in a row. Historically speaking, this company has almost always had a very high payout ratio. Now that isn't uncommon for an M-REIT, but in the past, Starwood has had a much larger margin of safety. According to their latest earnings call, the company did recently put another loan on non-accrual status, which means the borrower isn't paying interest to Starwood on the money that they owe. Their CFO said, "During the quarter, we placed a new loan on non-accrual, a $61 million mortgage and mezzanine loan on a multifamily property in Portland, Oregon. As of quarter end, our non-accrual loans and REO represents less than 4% of our total assets. Obviously, non-accruals are bad, and it's playing a role in this company's reduced earnings." Now, despite the non-accruals and having a payout ratio close to 100%, it doesn't mean that this stock should automatically be avoided. There have been quarters where the company did have a payout ratio exceeding 100% and they didn't have to go through a dividend cut. They can use some of the cash on their balance sheet or use a different method of making sure that they can still pay their usual dividend. I just think an investment in this stock would require a closer eye on it than others. What else I think is worth taking a look at is their dividend history. In the early years of this company, they saw a lot of growth with their dividend distributions, but in 2014, the company raised it to 48 cents per share and they haven't been able to increase it in almost a decade. They haven't been able to pay any special dividends either. I've seen some people tout this holding as being a very safe cash machine, and I wouldn't go that far given how razor thin their payout ratio has been. But what I think is great is that they are connected to one of the best real estate managers in the world, which is something that I don't think should be taken lightly in my opinion. My biggest concern is that if interest rates do remain high for a long time, that'll likely increase the number of non-accrual loans this company has. That would certainly reduce the amount of money they'd have to distribute to shareholders. Despite this though, the market hasn't seemed to be too pessimistic about this stock this year. It's currently up over 9% for the year without including the dividends. If we compare that to the Vanguard REIT ETF, ticker VNQ, we can see Starwood is doing significantly better. I've personally been considering this stock for a while, but I'll likely stay off to the sidelines until interest rates start cooling off. Hopefully they'll be able to post some better numbers in the quarters ahead. Earlier this year, I dumped another mortgage REIT because their payout ratio was getting way too thin, so I'm remaining cautious in this sector for the time being. But with that being said, that's going to conclude today's video. If you're interested, feel free to check out my Patreon where you'll find an Excel sheet of all of my holdings updated monthly. Plus it'll give you access to our Discord channel where we discuss higher yielding types of investments. With that being said, thank you all so much for watching today's video. If you liked what you saw, then feel free to hit that like button below and click subscribe if you want to see higher yielding investing strategy content. Again, thank you all so much for watching today's video, and until next time, take care.